Good afternoon, everyone who's joining us. Hopefully that's most people live on the webinar now. I hope everyone is well, and thank you for joining us for our Scotland Regional Economic Briefing by our Head of UK Forecasting, Kolodseike. For those of you who I have not met before, my name is Patrick Ford. I'm a Director in the National Capital Markets team based in Glasgow, and for my sins I've been asked to host this event. I also oversee global capital flows into the UK regions for Colliers and for the National Capital Markets Department. This being a web-based presentation means that we cannot see or hear you. There will be an opportunity for questions and answers at the end of the webinar, and you're all very welcome to send in messages with questions via the chat bar at the bottom of your screen. These messages are anonymous. If you'd like to leave your name, that would be helpful and put some context into the questions, and we can answer them. In addition, we will be taking some polls during the course of the presentation for you to respond to. We expect to wrap up the whole presentation and question and Q&A in about, well, hopefully under an hour. It's now more than 3 months since the organisers of MIPIM announced that because of concerns about coronavirus, the event was being postponed from March to June. The rescheduled event was supposed to begin actually this day last week, but as we all know, it ended up getting cancelled. Colliers Chief Economist, Dr. Walter Butcher, and Oliver Kolodseike were to have launched a research paper on the UK regions and cross-border commercial property investment at MIPIM. Instead, they have updated it to take into account the impact of COVID-19, and Oliver is publicly presenting it for the first time today. Just some context, Walter and Ollie have nearly 40 years of UK and European property industry experience, albeit most of that is Walter. They are one of the few that called it right in the 2015 general election result, which saw a Conservative majority, and also in the 2016 US presidential election, in which Donald Trump beat Hillary Clinton. Walter and Ollie have long been keen proponents of UK regional development and infrastructure investment. As you might expect, their views on regional investment and the effects of COVID are having are well worth hearing. I'll now hand you over to Oliver so he can tell you more himself.
Yeah, thank you very much for the introduction, Paddy. Good afternoon, everyone. Funny that you mentioned that it's 40 years of experience between Walter and I, but as you said, I probably only had 5 years to that. But nevertheless, I'm quite privileged to actually present his research today. And the presentation is split into 3 different parts today. So the main bit of the presentation will be about the research that was due to be launched at MIPIM. And it deals with the question of regional liquidity has increased or decreased since 2014, pretty much, when George Osborne introduced the Northern Powerhouse agenda. So we're going to have some very interesting comparisons pre and post financial crisis. The second part of the presentation is a general update on the Scottish market. So where is Scottish commercial property at the moment? What do you expect for the future? Are we still seeing deals being done, or has the market completely stalled? And then in the end, as Paddy mentioned, we should have around 15 to 20 minutes for Q&A. So hopefully some interesting questions come up during the presentation. Now, just to provide a bit of background information on research into devolution and regional revolution in general. So in 2012, Walter published a paper at MIPIM where he compared the UK regions to the German regions. And an interesting finding was actually that the German regions tend to attract more overseas capital than the UK regions. And then he looked into that. Why is that the case? You know, what are the differences between Germany and the UK? Now, being German myself, I know that regional devolution in Germany is very high on the agenda and has been very high on the agenda for a long time. So we have 16 different federal states, and they have a huge amount of political autonomy, and they're economically very specialized. So if you think of Hamburg, for example, it's the 3rd biggest port in Europe. So it's a trade hub for Germany. Frankfurt, obviously the financial center. You've got Berlin with a lot of arts and tech companies. You've got the Ruhr area, you know, a lot of heavy industry is still located there. Then you obviously have Munich as well, with the Oktoberfest. So you can see it's very specialized areas. Now, the reason for then updating this research was George Osborne's regional devolution drive in 2014 with the Northern Powerhouse Initiative. So the question that then came up was, is there any way of showing that regional commercial property market liquidity has improved since this initiative, or are we not seeing any improvements at all? And I think the first step for us was to actually define what does liquidity mean. Now, there are obviously a lot of different definitions in terms of liquidity in general. You know, I've written down a few here. But in terms of actually commercial property market liquidity, there's only very limited research out there. So then we thought, okay, what could be the key characteristics of a liquid market? And we think, you know, the main factor is how easy is it for investors and businesses to come into the market, and how easy is it to exit the market, which means is there enough supply and demand for certain assets. You can look at the market size. So, you know, how many transactions have taken place, what are investment volumes, and what's the scale of those transactions, so the actual size per transaction. You can also look at the market depth. So what's the investor base, the investor range? Is it mainly UK institutions or domestic funds, or is there of overseas capital flowing into the market? Another factor is leverage. So you could look at LTV ratios, how easy is access to lending and to funding, what are interest rates doing, things like that. And then political liquidity, I guess it refers to the political agenda. You know, are politicians, also business stakeholders, actively promoting the regional markets, and how well do they actually work with each other? So that's quite an important question as well. Obviously, a lot harder to measure than, for example, investment volumes. Now, if we go straight into it, so the first thing we did was we looked at transaction volumes. Now, the data comes from property data, and we looked at annual investment volumes between 2002 and 2006, and then 2014 to 2018. So it's 2 5-year periods before and after the financial crisis. And to be fair, the first result was actually quite encouraging. We thought, oh, research is actually quite easy because you can see that investment volumes have increased. So maybe we're done here. But obviously we weren't. Otherwise, the next 20 minutes of the presentation would be very, very boring. But you can see that in nominal terms, volumes have actually increased from 221 billion in 2002 to 2006 to 317 billion in the latter period. Now, the only problem with that was that if you put it in real terms, you see a completely different picture. So in real terms, adjusted for inflation's investment volumes have actually not increased. I mean, they have declined by 4 billion pounds. But in general, they were fairly stable between those two periods, but they definitely haven't increased, which left us scratching our heads. I remember Walter calling me. I was in Australia at the time, so I think it was very early in the morning or very late at night. And he told me about this, and he said, look, you know, we've done the research, we have the finding and the result that we wanted, and now this, what can we do? So then the actual research started for us, and we started looking a bit deeper into the numbers and the data. As I mentioned before, so in terms of real investment volumes have gone down. Deal numbers have in fact increased from around 12,000 to 15,000. But nevertheless, you know, in terms of the regional liquidity, you know, it was not what we wanted to show at all. And it was not going to be a good paper for MIPIM, right, if that was the main finding of the research. And before I come to the dig down into the data, I had a look at Scotland as well. So what happened in Scotland during the same period? And Scotland, in fact, fared worse than the regions and the UK as a whole. So in Scotland, liquidity measured by real investment volumes fell by 30%. the deal size declined by a pretty similar amount. And I'm going to talk about that in a bit more detail later on as well, why Scotland has performed a bit worse than the UK. But don't forget that the Scottish economy during that time underperformed the UK. The oil price was falling, you know, that we had the Scottish referendum. There was a lot of political uncertainty, which I'm going to mention in a bit. So there we were. Why did we find these results? Can we explain them? You know, can we at least explain why liquidity may have not increased? And I think number one was that the whole lending and leverage environment before the financial crisis was completely different to what it was after. If you think about the amount of, you know, risky debt that was in the market before the crisis, where lending was very easy, everyone was fairly driven by high risk investments, and banks had no problems to actually lend at conditions that no one could imagine anymore. Part of that obviously led to the financial crisis. And there's a lot more regulatory control now. So, you know, it's not as easy anymore to get a big loan. The whole risk environment has changed completely. And what this chart actually shows is the average maximum LTV in the commercial real estate. So before the financial crisis, you know, you could leverage up to 80%. But now this is more down to 60%. So it's a big drop in average LTV ratios since the crisis. Another thing we looked at was shopping centers. So everyone knows the retail story right now. You know, it's going through structural change. There's not much interest for shopping centers anymore. So we thought in the 2002 to 2006 period, there was a big interest in shopping centers, you know, in big ticket items, big assets. And we then thought about, what if we just strip out shopping centers completely for the analysis, just to see how transaction volumes have changed if you exclude those. You could call them highly volatile assets, just because interest is so low at the moment. And the result was actually quite interesting. So if you strip out shopping centers completely, you could actually see that regional liquidity would have increased by around 21%, pretty much in line with London at 23%. And just to highlight the scale of shopping center investment, I put a little table at the bottom right of the slide, where you can see before the financial crisis, there were 555 shopping center transactions. So that's between 2002 and 2006. And then this number has halved for the post-financial crisis period between 2014 and 2018. In terms of nominal value, again, you know, the value has halved. And then in terms of real value, it's actually more than half. So in terms of real value, shopping center investment, the value went from 32 billion before the financial crisis to around 11 billion after the financial crisis. So then we thought that's quite a good result, but it's probably not enough, because you can't just say, what if we just strip out one asset class and then treat the market as complete? Sorry. Let me just go back. Don't know what happened there. Right. So yeah. So as I said, we weren't quite satisfied with the findings here. Now, I mentioned that already. Scotland obviously had some other issues as well compared to other UK regions. So you know, it was quite important to actually look at Scotland by itself, not just as a whole region outside of London. And I think the chart at the bottom right is quite telling. So what it shows is the oil price development in the 2002 to 2006 period, that's the light blue line, and then the 2014 to 2018 period in the dark blue line. And I indexed the oil price to 100 at the start of the respective year. So it's 100 in Q1 2002, and then it's also 100 in Q1 2014. And you can see how the oil price developed in those two periods. So between 2002 and 2006, the oil price rose by 133%. But then, I don't know. So that I'm not pressing any buttons. But then between 2014 and 2018, the oil price actually fell by around 50%. So again, you know, Scotland's economic environment, political environment, very different to other UK regions. The Indy referendum in 2014 also played quite an important part. There was a lot of uncertainty, which actually led to fairly high degree of hesitation amongst UK institutions to invest. Now, how does liquidity then actually vary by market? You know, and you know, the simple answer is yes. And there are a lot of different reasons for that. I mentioned already the oil price crash in 2014 and the referendum. Also, the Brexit vote has affected some regions more than other regions. But I think one of the very important feature of a city is how attractive is it to an overseas investor in general. And some things like university, how educated is the workforce, you know, they are quite important to overseas investors. So, for example, you know, Manchester United, you know, Liverpool. If you look at Manchester and Liverpool in those two charts on the right, they're doing pretty well, and a lot of that is actually linked to their football teams. You know, there's a big Asian follower base for Manchester United. So if they come to the UK to invest, you know, they look at other regions outside of London, and if they look at them, they look at Manchester. So I think there's definitely some degree of cultural attachment to the different regions. And this is pretty much where we thought, okay, we're quite close to actually cracking this whole puzzle in terms of regional liquidity. Has it improved or decreased? What if we just look at overseas investment in general? You know, how much overseas capital has come into the regions, and then compare those two periods. And you can see that the overall amount of overseas capital has increased by quite a lot between 2002 and 2002 to 2006 and 2014 to 2018. And the chart at the top right shows how this cross-border investment is made up in terms of the origin of capital. So Irish investors almost completely left the market between those two periods, while other investors, especially Middle Eastern and Far Eastern investors, came into the market. Now, I think it's quite important to distinguish the motives of those investors. You know, I think Irish investors, they were more after high risk, short-term investments, whereas a Middle Eastern or Far Eastern investors is looking for more long-term secure income. So they want to stay in the market for a lot longer than just a few years. So they're looking at a bit lower risk and maybe more subdued returns than, you know, the high risk returns that you may or may not expect. But generally, it was a positive picture because we could actually show that the overseas share of regional investment has increased from 12% to 23% in those two periods. And if we look at Scotland again in more detail, the bottom right chart actually shows the total overseas investment volumes. Those are the bars, and then the line refers to the overseas share of all investment in Scotland, all commercial property investment, that is. And you can see if you compare 2002 to 2006 to 2014 to 2018, the share of the overseas capital has actually more than doubled from 19 to 41% in Scotland. And this is a lot higher than for the whole of the UK regions, where it has increased from 18 to 24%. And you can see the last few years have been very, very positive in terms of overseas investment in Scotland. You know, we broke the 1 billion mark. I think it's 5 out of the last 6 years, 5 times of the last 6 years. So it's very encouraging. And we're definitely going to talk about that a bit later as well, of why that is the case and are we still actually seeing this. But generally, we were quite happy with those results, you know, because we were able to see liquidity as measured by the share of overseas investors has increased across the regions and across Scotland, even a lot more substantial. So before I now talk about the Scottish markets in a bit more detail, the key messages are that on some measures you could say that liquidity has decreased, but on other measures it has definitely increased. In terms of overseas capital, overseas share of all investment, it has increased. In terms of the actual deal numbers, it has increased as well. And we must not forget that the 2014 to 2018 period was substantially impacted by the oil price in Scotland, the Indy referendum, Brexit negotiations. So there was still a lot of political uncertainty and economic uncertainty. And I think, if you take that into account, then the regions have actually performed pretty well. And we don't know how they would have performed without all of the uncertainty, but I don't think it would have been worse. And I think, sterling definitely helped to limit some of those negative impacts. I think there was around a 15% decline in sterling between those two periods. So it was a bit more beneficial for overseas investors to come to the UK. And if you think about the UK commercial property market, more broadly speaking, it's still a very transparent market, a very stable market. The political environment is stable now as well. We had a lot of uncertainty over the past 3.5 years, or 4 years almost now, but it's relatively stable now. And ultimately, I would argue that investment in the UK is not a zero-sum game. So it's not I either invest in London or in the regions. It's not one cost of the other. So, there's still enough global capital out there to target all of the markets. And I think investors that are looking for more competitive pricing, they have to look outside of London. In terms of supply, there's not much in London actually on the market in terms of big ticket items. I think especially want to look for some higher yields, you have to look outside of London. And Scotland is definitely quite an attractive alternative. So I'm now going to spend probably the next 10 minutes or so just to give you a brief update on the Scottish commercial property market at the moment, and then a bit of a COVID outlook as well. So in terms of investment volumes, 2019 was actually a fairly strong year. So investment volumes broke through the 2 billion mark again for the 6th year in a row, above the 10-year average. So it looked pretty positive. And don't forget, 2014 was the referendum, the Scotland referendum, and investment volumes surged. But then uncertainty in 2016, 2017 surrounding Brexit, didn't really deter investors. So they were still coming into the market, which is quite a positive sign. And in fact, the first quarter in 2020 was actually fairly positive too. So investment volumes were stronger than they were this time last year. And the year was looking good at the start of January and February, but then obviously once the pandemic hit, valuations weren't possible anymore. You weren't able to visit sites. I know they have reopened now and inspections are taking place again, but we pretty much had two months of complete lockdown where no inspections were able to take place, and activity plummeted quite considerably, not just in Scotland, but across the UK, or globally. If you look at China and the US, even Europe, investment volumes in Q2 have dropped right down to levels they haven't been in a very, very long time. But on a more positive note, and I'm sure Paddy will talk about this a bit later as well, deals are now taking place again. There are a number of assets that are under offer, and there are a few transactions that actually have taken place during lockdown. Right, so in terms of COVID, so I'm obviously not a scientist, I'm not a doctor. I can only report on what I read in the news, and I can only analyze the data that I have. But generally, the positive news is that the COVID cases are coming down, the death tolls are coming down. And I just heard Nicola Sturgeon's daily briefing earlier, and she said, I think there were 7 reported deaths in Scotland in the last 24 hours. And there was 0, I think, yesterday and the day before. So the death toll is coming down, and that's very encouraging. And I don't know if there will be vaccine. No one knows. I know people are working on it. A lot of research is done in the UK. But from the data that we have, it seems like we are through the worst now. And if there's no second peak, then we certainly are. Now, an interesting poll I found was actually conducted by YouGov, and they've been tracking the fear of catching COVID across the UK. That's the bottom right chart. Now you can see the index peaked at the end of March when the lockdown came into place. It was fairly stable, but it's generally been trending downwards since. So it would be interesting to see how this develops as more restrictions are eased and people return to a more normal way of life. Now, what do we predict for the UK economy in general? Now, obviously, we do a lot of forecasting, and to some extent, forecasting at the moment is quite easy because if there's a very sharp drop in Q2, there will be very sharp rise in Q3. Now, the magnitude of that is obviously very, very difficult to predict and to forecast. And we also have to remember that we are probably through the worst now, but the official data hasn't shown the worst yet. What do I mean by that? So the Q2 GDP data for the UK won't be published until August, I believe, which means by August we will still have to deal with a negative news agenda around the economic crisis. And that's not good for consumer confidence, for business confidence, if they still read about this in 2-3 months' time. And we just have to remember that the economic data only shows us what has happened already. It's not an outlook. It doesn't show us where we are right now. It just tells us how bad it was. But I do believe, and most economic forecasters agree, or I agree with them, that we should expect a pretty sharp bounce back in Q3. Now, it will take some more time to actually return to the levels of GDP that we have seen before the crisis. So the size of the economy will still be below COVID for probably around 1.5 or 2 years until it's fully recovered. And the Q3 GDP results will be driven by base effects. And what do I mean by base effects? If you just think that 50% of all factories are shut down right now. Now, if we just reopen those 50% of factories and they just go back to producing something, then there will be a big increase in production levels in general. So if you just apply that to the economy, I know it's very simplistic and it doesn't work like that, but it just gives you a bit of an idea how base effects work. So we should expect a very sharp bounce back in Q3. Now, the labor markets will lag behind considerably, especially given the end of the furlough scheme in October. We don't know how many people will be unemployed or how many people will actually carry on working. And that will ultimately decide how sharp the recovery will be post Q3. And why is that? Because a lot of the recovery depends on consumer spending. And if people are unemployed or they work at 80% of their wage for a considerable amount of time, they have less disposable income, less money to spend, which obviously then negatively impacts on the economy as a whole. Now, what I would also like to mention is that the UK is actually expected to recover more quickly than most other European countries. So you can see on the bottom right chart, Germany and the UK are predicted to recover fairly quickly compared to other countries, but then France and Italy, and they will lag behind as well. Now that's down to many different reasons. There are structural problems, especially in Italy. Unemployment in Italy and France was still reasonably high even before the COVID crisis. And there's a lot of politics going on as well. But what I would say is one of the main factors why this is the case is that the UK has a demographic advantage over many other European countries or even G7 countries. And what I mean by that is that the UK working age population is still predicted to grow over the next 5 years, while in many other parts of Europe, the working age population is actually expected to shrink. So Germany and Italy, they actually forecast a declining working age population, while the overall population is still going up, which means there will be less people to care for the elderly. So dependency ratio, as we call it, is a lot higher in those countries. Notice any regional difference in the UK in terms of the economic recovery? The answer is, yeah, a little bit, but not too much actually. So I know you can't see much in the top right chart, but it just plots the different regional cities in the UK and their recovery path. And they all look fairly similar. A regional economy might go down by 5% and then go up by 5%, or it might go down by 4% and then go up by 4%. But generally speaking, they're all on the same path and the same trajectory. And to highlight that, the bottom right chart shows you how the regional cities compare to the UK. So this is the total GDP growth compared to the UK average, which means London will be 1.5 percentage points, or grow 1.5 percentage points faster than the UK as a whole over those 5 years. Belfast, the worst performing city that we've analyzed here, it will perform 1 percentage point worse than the UK. But generally speaking, all of the regional cities should recover quite strongly and should bounce back fairly quickly after this crisis. I don't know how many of you have seen the latest IPF forecasts. So the IPF, it's a consensus forecast across property companies, investment funds, some private equity firms. And there are specific questions about rental growth expectations, yield growth expectations, and total returns across different sectors. It's a quarterly survey, and Colliers is a participant of this survey. Now, the first interesting result was actually that a lot of companies didn't contribute to the forecast this quarter and also not during the last quarter, simply because it is so difficult to forecast accurately at the moment. If there are no valuations taking place, how can you make comments about yields? It becomes very, very difficult. And Colliers was actually one of the companies who have decided not to contribute for this very reason. Nevertheless, there were some forecasts based on a smaller sample size. And as you would have expected, there are substantial downward revisions across the board, across all sectors. And what I plotted here was the forecast for total returns across the three major sectors, and then for all property also in green. So yeah, the big hit will be in 2020. All property returns expected to be down by around 7 to 8%, driven by retail, shopping centers, but then also out of town retail, performing very, very poorly. And we would say that coronavirus definitely accelerated the structural changes that are happening in the retail industry anyways. The industry and offices holding up somewhat better, but nevertheless, they will probably see negative total returns this year too. Then the recovery path, I said it's slow. It's probably not as quick as the economic recovery, just because property doesn't trade quickly, and it's more a longer term game. But nonetheless, returns should return to positive growth next year, led by the industrial sector, which should perform a lot stronger. There's many reasons for that. Online retail has reached, I think, its highest share ever on the latest data. The last mile delivery is becoming more and more important, and just changing consumer behavior contributes to this shift as well. Now this might probably a little bit confusing to most people, so I'm just going to spend a minute or so explaining what it actually is. So I call this the IPF Consensus Forecast Uncertainty Matrix. That's quite a word. And what it shows is actually on the x-axis, it's the range of forecasts. And this is for rental growth. What's the range of forecasts? So as I mentioned before, there's a consensus survey sent out to property firms and investment managers and so on. And then all of the answers are collected, put into an Excel sheet. Then we have an average consensus view, but we also have a minimum and maximum estimate of rents, of total returns, of capital growth. And the Q2 range, this is the minimum compared to the maximum. So what's the range of those forecasts? And it could be that, I remember at the end of last year, the range was very, very low because, you were in Q4 already, you knew that industrial rents would go up. So there was no massive range, it might have been from, 3 to 5%. Whereas this time around, the range is a lot higher. So that's on the x-axis. Then on the y-axis, I actually plotted the difference in the range between Q1 and Q2. And what does that mean? So it means that we should, in theory, expect this range to narrow from Q1 to Q2. Because at the start of the year, we don't have any information or very limited information about commercial property for that given year. But then as we move throughout that year, more and more information comes in, which should mean that the range of forecasts should, in theory, narrow. So the gap should narrow. Now, when that doesn't happen, that means there's something wrong. And it means there's a high degree of uncertainty if this range actually goes up. So what I then did was I just divided this chart into 4 different areas. I'm not going to go through everything here, but you can see the right top area. I call it a high degree of uncertainty because the range of forecast is very high and the difference in the range between Q1 and Q2 has gone up. So uncertainty has increased. Now we have 2009 and 2020 in there. And what do these years have in common? Big economic decline and recession. So that was just one way of illustrating the data in a slightly different way. It just shows how difficult it actually is at the moment to come up with accurate forecasts or with forecasts in general. Nevertheless, we're still fairly positive about the outlook for commercial property in general. Now, obviously, 2020 will be a bit of a write-off. The economy is declining, investment volumes are going down, and there's no hiding from that, and everyone knows it. And reporting anything else wouldn't be accurate. But I think that beyond 2020, the global weight of capital will still target real estate, and that's for several reasons. Number one is bond yields and interest rates are expected to remain very low for a long time now. And if investors and funds are looking for higher returns, they have to look elsewhere. And commercial property has been very attractive over the last few years, and we believe that it will continue being an attractive alternative. If you think about pension funds, they have liability matching, they need to look for long, secure income for annuities. So commercial real estate, again, is one of those asset classes where you can get exactly that. The demographics play an important part in that too. So generally, the global population is aging, stronger in other countries, but it means that pension funds will have to look for this annuity matching. And I think there are some sectors that might come out more positively than others. So if we look at multifamily, senior housing, PIS, so like any sector that is linked to demographics will probably benefit from this working age population growth. So yeah, just to quickly sum up before we come to the Q&A. So the research that we conducted has shown that there were some measures on which liquidity has actually declined, right? So that was the starting point of our research. In real terms, liquidity has not improved regionally. So that's why we then looked into the data in a bit more detail. And what we then found was that it has actually increased on other measures, and most notably, if you look at the overseas share of all commercial property investment, there's big improvements across the regions, in Scotland in particular. Now, the global weight of capital will continue to drive demand for commercial real estate in general. And why are overseas investors still coming in? Monetary policy is very loose across the globe. So interest rates are very low in other countries too. So if those overseas investors want to come in, it's fairly easy for them to borrow money cheaply. We also saw that there will be a hit to the economy. There's a hit to the property market in Q2, but this should recover later in the year. the recovery path in general remains very uncertain. We don't know if there will be a second wave. A lot depends on how restrictions are eased, how the R rate is evolving, and how governments and policymakers continue to support the economy. So I think that's it from me for now. And I think we'd like to do the polls now. Chanel, please. So the first question that we have for you is, given the pandemic's negative impact on the UK economy, do you think that the government will keep its manifesto commitment to invest in the UK regions? Yes or no? So if you could all vote now, please, and then we wait for 20 seconds and show you the results after. All right, that's fairly encouraging. I would agree with that. I think that's probably the outcome we would have hoped for. Would have been very difficult to explain a different outcome. Right, if we go to the next question. How confident are you that Scotland will fully recover from the pandemic and its economic impact? Fully confident, somewhat confident, not confident at all. Again, if you could vote now, please. Okay, that's not bad. So 20% say not confident at all, but the large majority of the panel is actually somewhat or fully confident that Scotland will recover, and I would agree with that. And then the last one, please, Sean. So notwithstanding the typical ebb and flow of occupational needs as businesses expand and contract, overall, do you believe office tenants will require more or less space as a result of the COVID-19 epidemic? So will there be more or less space requirements for offices after COVID? Okay. That's very interesting. So the large majority thinks there will be less requirements for space. I mean, this might be a good opportunity to actually hand over to Paddy for an explanation of this result.
Yeah,
Paddy,
well,
anything to add to that?
yeah, swiftly on to me. Well, look, thanks, Ollie, for that presentation. It's really interesting. Obviously, lots of different moving parts. On the offices side, there's arguments both for some tenants needing more space and for tenants reducing their office exposure. You know, at the minute, there's no right answer. That's the only thing we definitely know for sure, because if we were crystal ball gazing, I think depends who you speak to. There's certain people who have their own agenda to push. For example, some office developers or office agents, certain landlords trying to suggest that things will probably be a little bit more rosy than they might be. I know there's personally, I've not set foot in my office since the middle of March. Colliers have opened their offices in London at the start of this month, and people are slowly going back, certainly in England. In Scotland, I think there's a trickling effect. You can't go back to the office, but I know, having driven through Glasgow city centre yesterday, that it was a very quiet place still, and verging on ghost town. For the rest of this year, there's going to be certainly very, very low levels of office occupancy, but it's going to increase over time. That's for sure. But you know, my gut feel is there's probably going to be less space used in offices overall, but that there's still going to be a need for offices. And certainly from an investor standpoint, it's going to be much more of a focus on prime offices in the best locations as opposed to secondary. I suppose we could move on now just to the other questions and answers. See, thanks very much for your questions so far. Please don't be afraid to put your name on it, as long as it's not rude. We'll certainly give it some airtime. Ollie, do you want to start off, kick off with some of the questions that have come through so far?
Yeah, that sounds good. So Question number one, will the UK Scottish government increase taxes? So I would say not right now. So I think any increase in things like the income tax or VAT would limit consumer spending even more. So I don't think this will be done in the short term. We also mustn't forget that the Conservatives' manifesto actually promised not to do any of those. Now, whether or not this manifesto will be broken in the medium longer term is a different question. But I don't think that there will be any tax increases in the short term. I just don't think it would be any beneficial to the economic recovery overall. Now, will there be things like a pension tax relief for higher earners? Will that be scrapped? I'm not sure. Or residential property taxes. I don't think that they would change, because if you think about removing all of those tax incentives for residential property transactions, it would just limit activity in the housing markets. And again, that's something that the government doesn't want. So I think will taxes go up at some point? Yes, but not in the short term. Again, I'm not a political expert or political analyst, but that would be my feeling. They will go up, but not yet. Right, if we go to another question here. What is your view on build to rent in Scotland and investment appetite? Right, so I think...
Ollie just broke up slightly there. What was the question again?
Oh, sorry. So the question was, what is your view on build to rent sector in Scotland and investment appetite? Did you get that?
Yeah.
Okay, so...
You can answer that to start off with.
Okay. I'll try to answer that. So I think the build to rent sector in Scotland is not yet fully matured. It's not as developed as it is in other UK regions. And I think there will still be a lot of appetite for that. And what I mentioned in the presentation as well is that a lot of investment interest in the future will be linked to demographics. And there's quite a lot of demand for housing across the UK, also in Scotland. There's a lack of housing supply. The rental sector is becoming more and more important because of affordability issues and problems. So people are not really not able to afford their first home anymore. So I think my view on the build to rent sector in Scotland is that it will grow in importance, and that investment volumes will probably go up quite considerably in the future.
Yeah, for what it's worth, I think on the residential side, kind of mid-market affordable housing and social housing is going to become increasingly in demand from investors. I think on the kind of living space piece, student housing is going to be fairly resilient. The fundamentals are strong, but there's going to be a bit of a caution over numbers of students in 2020, certainly after the summer, and 21, particularly in second-tier universities that rely on foreign students, and the cost of fees for local students. It's going to come into view. On the hotel sector, I think there's going to be distress there. Certainly, government stimulus helping, but so there's no distress quite yet. But at the minute, operators are using skeleton staff or shutting or furloughing staff. It's going to be interesting with what's happening with Travelodge, what's happening there, but also just the recovery for top-tier luxury hotels. Probably take a bit longer due to travel bans.
Yeah, I think that covers it. Right, we've got one here. How has COVID affected each of the sectors? Maybe you want to make a start on that, on what you're seeing at the moment, Paddy?
Sure. Well, offices remain fairly resilient, notwithstanding nobody's actually been working in them for the last couple of months. I mean, rents in Scotland, certainly Edinburgh and Glasgow, speaking to agents, they're generally holding up. Low incentives are moving out, as you would kind of expect. Yeah, the preference from investors is for stable income rather than value add, because there's so much uncertainty around rental levels and incentives and void costs at the minute for offices. It's just going to be interesting to see how hygiene and density levels were assessed after COVID-19, as well as we all know, really the success of remote working. It's working certainly pretty well for some people, but I know a lot of younger folk prefer being in the office and having the company. On the logistics side, it's very resilient. Grocery companies are wanting more space, but not all online sales are strong. There's a new generation of online users following lockdown, and there's definitely more demand for e-commerce. So all of a sudden, my mother is now ordering things on the internet that she wouldn't have done before. Supply chains are going to be reassessed, but labour markets are more costly and thin. I think there's just a lot of emotional chatter about kind of high streets and the like, but I think logistics is certainly here to stay. And there's no doubt there's going to be a lot of distress in the shopping centre space and high street space. But there's going to be demand for long income, grocery and convenience, food retail. So, and where there's shopping centres potentially with alternative use place, there's going to be an interest from investors, but I think that's still a while off.
Yeah.
What do you think, Ollie?
I'm probably, I mean, I've got fairly similar views, I'd say. The office sector is just a bit of a hidden myth at the moment. You talk to one agent, then you talk to another agent, and they're seeing different things. So I think it's quite difficult to come to a conclusion on that. What I would say is that I think the regions would probably benefit from it, from regional diversification in the office sector. There are a lot of big companies that want to set up some satellite offices. So the regions would definitely benefit from that. Industrial, it's holding up. Activity is fairly limited, but we mentioned that before, and that's not because there's no interest in the sector. It's just because you can't do any viewings, or you weren't able to do any viewings. Retail, I think COVID is just accelerating the structural changes that are going on in the sector. I think you covered the rest of it pretty well. So. Right, there's one more here. Why has Scotland outperformed the rest of the UK when it comes to appetite amongst overseas investors? So I think that there are several reasons for that. I think pricing in Scotland is fairly competitive, especially if you compare to other UK regional markets or even European regional markets. An investor looking for slightly higher yield can go to Scotland and find that actually there, while the market is still fairly transparent and stable. So it's still got the political and economic certainty, if you like. Not so much at the moment, obviously, because of COVID, but in general, the Scottish market is fairly transparent and stable. I also think there's quite a lot of occupier demands if we go back to the offices, but there's limited supply, right? So it means that there will always be demand for that supply that's actually there, and thereby leading to increased rents, thereby providing some stable longer-term income. I would also say that, Scotland has actually very, very good universities. The reputation of the Scottish university around the world is absolutely outstanding. I think I checked the university rankings the other day, just out of interest, and I think there were 3 or 4 Scottish universities in the global top 100. So that's quite impressive. So the workforce is very well educated. Unemployment in Scotland is lower than in a lot of other regions in the UK. And if you have that educated work pool, as an investor, that attracts you towards the city as well. Let's not even talk about the cultural heritage and everything. So I think Scotland will remain very attractive. And part of the reason why it outperformed other regions is probably the search for higher yield and the strong occupational demand, I would say. Don't know if there's anything you want to add to that, Paddy, or happy with that?
That's fine. Any other questions at your end? There's quite a lot of questions coming in from
there's a few
watching the webinar. I need to take out all the really difficult ones, or else you can answer them, Ollie.
Let's see, what do we have here?
John, just dive right into the most the most difficult one, most contentious, potentially the one that nobody ever raises their head on. Somebody, an anonymous attendee, has asked, would you agree that a second independence referendum at some point over the next few years is likely? And if independence happens, what impact will that have on investor sentiment? Well, I'll kick off. I'll kick off with what I think are probably just my own layman's views as a humble surveyor. Do I think a second independence referendum at some point in the next few years is likely? At the tail end of last year, I would have said yes, because of what was happening politically in Westminster. After probably the last 2 months, I would say no, and there's a reason for that. I think because of basically what's happening down in Westminster with the economy, with what the Chancellor's doing in terms of economic stimulus to try and keep everyone in jobs, with furloughs, with the sheer amount of borrowing that's required to pay for it all for the UK government. I think it's going to be very difficult for Scotland to try and extricate themselves from that purely from a financial point of view. The potential cost per person of every Scotsman and woman to take that burden of the debt is just going to be really pretty eye-watering. So in the next few years, I can't see it. I think there's just been too much kind of change, too much uncertainty generally, politically, economically in the UK over the last couple of months, and what's going to happen over the next few years as a result. If it does happen, if there is another independence referendum, what impact will that have on investor sentiment? I mean, there's no, it's going to impact it, and it's going to impact it negatively. It will introduce a level of uncertainty into the property market, and that has no other effect other than just to cause a negative impact from investors. Because frankly, why would you buy an office in Glasgow or Edinburgh whenever you can buy the same office in Manchester and you don't have that political risk? So that's what I think will happen. What do you think, Ollie?
Yeah, I mean, it was the one question I tried to avoid. I mean, there won't be a referendum this year. You know, the SNP already said that. Over the next few years, I don't know. I think that with the oil price being so low and forecast to remain so low for some time, it would be very difficult for the SNP to actually make a case. You know, if you think about how dependent Scotland is on oil revenues, and if oil revenues are that low, and you know debt is going up by that much more than at the overall UK level, I think, yeah, from a financial perspective, it would be very difficult to make a case. I think. I do think they've handled the whole COVID crisis pretty well, and I think there's probably some sense of unity coming through that. But yeah, will there be a second referendum? I wouldn't count on it. No, I doubt it.
Okay. As another questions come in, whereabouts is in the world are most investors interested in investing in Scotland? So whereabouts is a global capital that's looking at Scotland coming from? I'll do a very quick whisk around because this is part of my day-to-day job now. I mean, at the minute in Scotland, in 3 transactions, there's about £250 million worth of offices under offer in Glasgow and Edinburgh at the minute, and that's all through Southeast Asia. The capital's coming from Southeast Asia. So there's quite a lot of optimism from South Korea, Hong Kong, Japan, and Singapore for Scotland. And that may well be as a result of them kind of being the first in to the COVID crisis, potentially the first out. One thing to just outline is Malaysia's new government has restricted capital flows due to COVID-19 and currency issues. The Middle East have always been quite interested in Scotland for one reason or another. Maybe it's the link with oil, but the capital from there is completely paused really due to oil price falls globally, and also Ramadan kind of dovetailed with the crisis at the end of April and just finished there at the end of May. I think the debt market will impact as well for the Middle Eastern investors. So that source of capital is probably not going to come till the end of the year. I think European capital is generally on pause as they try and assess their existing portfolios and sort out whatever income might have been lost during lockdowns They're definitely looking at Scotland, but I think the investment committees are very cautious in the short term, and very few decisions are being made. In America, there's a lot of private equity that is ready to go, and the private equity funds realize there's going to be distress in the market at some point, but they won't arrive in Scotland immediately. German capital is fairly optimistic in Scotland, and probably prioritise the UK generally for investment over the whole of Europe. Due to the hedging costs that they've got, they generally want assets about 4.5% for stable income. And in fact, they've just bought recently in Edinburgh a really good quality office that was refurbished, and I think they set a record yield for a refurbished office in Scotland, sub 4.5%. So currency is coming into play by all global investors with the weak sterling, and I think global capital is continuing to really impact the Scottish market.
You just got a little nudge that we passed 3 o'clock now. So I guess if there are any more questions, feel free to email us, and we'll get back to you, I'd say.
Yeah, thanks Ollie, and thanks everyone for listening. We've just gone past 3 o'clock, so that will probably be us for now. If anyone would like to get in contact, please don't hesitate to contact Oliver or myself through our emails at colliers.com. And hopefully everyone's well, keep safe, and we'll see you on the other side. So thanks very much.
Thank you.